our speaker, Ben Lees, who was born and raised in the Pacific Northwest, where his firm Delphi Advisors is located. And he's been in the investment business for over a dozen years. And he's also presented at other AI chapter meetings with good results. So we're pleased to have him here. And he actually is a local living in this area. So at this point, we're all eager to hear how the presidential election, I guess, and it's a question of, depending on who you talk to, whether it's actually been decided yet, will affect the markets. And of course, we're dealing with COVID and the outbreak there. So at this point, I'll turn the mic over to Ben, and please go ahead, Ben.
Thank you, Todd, and thank you for the introduction, and thank you to AAII for having me back again. I do enjoy these topics and enjoy giving these presentations, so I'm glad to be here with you guys today. So good morning, everyone. I'm going to share my screen here with everyone real quickly, just because I have one more thing I want to talk about administratively before we move on. Okay, so you may see a set of tiles with some of our videos on the right-hand side there. If you see that and it's in the way of my slides, blocking the slides, you can click at the top of that. There's a little single line on the left-hand side, and it will minimize that so you can kind of get it out of your way, kind of give you a little bit better view of the slides. So as my presentation is titled, we're going to talk a little bit about the state of the markets today, right? We're gonna focus on politics and COVID-19. I do have my video on for the moment. I will turn that off here shortly, but I wanted everybody to be able to see me as I introduce myself. I think seeing a speaker always helps to be able to relate a little bit to that person speaking. I do know that I have a face built for radio, so just bear with me, and I'll make sure that I turn it off shortly here, I promise. So I know you're probably wondering, right, why should I listen to this guy? What does he have to offer, right? What is his expertise? Todd gave you a little bit about my background, and I'm going to dive a little bit more into that. So before we get into the details here, I am going to give you some tidbits and hopefully earn a little bit of credibility so everyone can bear with me over the next hour or so. That being said, this is an incredibly difficult topic, right? No one is correct 100% of the time, especially when it comes to markets and analysis, right? When we forecast or analyze markets, we're trying to make sense of the unknown, right? We're trying to simplify complexities so we can make 2 + 2 = 4, if you would. But sometimes in markets and analysis, no matter how much you try and how much analysis you do, you can't get 2 + 2 = 4. And sometimes 2 doesn't even end up being a number in this business. So I do urge everyone to get information from multiple credible sources before any investment decisions get made, because I know how important this is to everyone. So who the heck am I anyway? Right? Well, as Todd mentioned, my name is Ben Lees. I am the founder, president, and chief investment officer of an investment management company that I started called Delphi Advisors. It is located right here in the Pacific Northwest, Vancouver, Washington specifically. I have been involved with investment analysis for about 20 years now. I started in real estate investing in my teens and early 20s, and then moved from there into stocks and bonds, and now I do everything from currencies to options. I've pretty much run the gambit on investment analysis. I've worked directly in financial services for about 10 years now as an advisor and a portfolio manager. I specialize in portfolio engineering and investment management. What this means is I build portfolios and investment strategies for my clients that are designed to help them meet their long-term goals by maximizing risk-adjusted return. And ultimately, I'm just trying to help them live their lives, get to their future goals without having too much stress, right? That's the idea of maximizing that risk-adjusted return. What I am not is I'm not a stock picker or some sort of style-specific asset manager. I believe very strongly that there is no one style or type of stock that is best for all time. I do analysis on a macro level, looking at things like sectors, countries, and styles as well, and I adjust portfolios in accordance with what the market is telling me, or what I can glean from the market. I have a bachelor's degree from the University of Washington. I have an MBA with a specialization in international business from Portland State University, and I have a certificate in business strategy from Cornell. I have been featured in a number of different publications. I'm sure you've heard of some of them: Wall Street Journal, Money Magazine, Fortune, and I'm also a member of a number of different associations. The Fee Only Network, the XY Planning Network, and the National Association of Personal Financial Advisors. That one is always a mouthful. And my business, Delphi Advisors, is an A-rated accredited business with the Better Business Bureau. I hope that helps kind of give you an idea of who I am and what I do, and at least helps you get through the next hour or so with me. I'm going to go ahead and turn my video off now so you can get the full screen view. And then we'll move on to the agenda for today. So bear with me just one second. Okay. We're going to start by talking a bit about markets and the economy specifically, talking about what markets are and how they function. I'm not going to get into fixed income or bonds on this presentation, but I am happy to field questions at the end about that topic if anybody is interested. I'm then going to take us through the two hot topics on all of our minds, right? The recent elections and COVID-19. I'm going to focus on how these things affect the markets. I'm going to try and stay away as much as possible from any editorial or my opinions here. I'm just going to focus on facts and markets. Then I'm going to discuss the key takeaways from these topics and also give you some forward-looking thoughts. And the last two topics are going to be brief. I'm going to give you a bit of an overview on portfolio engineering and portfolio construction, and then a few tips on how to select an advisor should anyone decide that they would like some help with any of this stuff. And then we're going to go ahead and finish up with some Q&A for the remainder of the time, probably about 30 minutes or so. So what the heck are equity markets and how do they work? At the most basic level, equity markets are a mechanism for investors to own portions of publicly traded companies, right? Seems pretty simple. And without public equity markets, it would be incredibly difficult for individuals like us, like ourselves here, to invest in businesses and create wealth very easily. But in order to be a successful equity investor, we need to understand a little bit more about the pricing function, the pricing mechanism of equities and how that works. Many people don't really think about this very often, but the price of any stock or value of any stock market is in fact a function of the supply and demand of those underlying equities themselves, right, of the equities themselves. Meaning that if demand outpaces supply, then stock prices rise, right? If supply outpaces demand, then the prices fall. In the short term, it's demand that dictates value. But over the longer term, pricing is affected, believe it or not, more by supply, right? As companies will manipulate the supply through things like secondary offerings, initial public offerings, and stock buybacks. But that takes a long time to accomplish, and investor demand can shift really at a moment's notice. Thus, the effect of demand on pricing is short-term and immediate and reflects how investors view future profitability of a company. meaning that investors will buy or sell stocks today based on what they expect from that company or market in the future. This is why equity markets are a leading economic indicator, and the equity markets tend to move before we see any economic data move. This is also the reason why it is so hard to forecast equity markets with any degree of certainty. And being a leading economic indicator means that the price of equities, the price of stocks, already reflects any widely known information, right? Anything that's out there is already priced in. So anything you've heard on the news, or someone tells you at a cocktail party, or a stock tip you get from a buddy, right, is already reflected in that current pricing. You need to have different information or interpret widely known information differently to get ahead of equity markets. So I'm going to talk a little bit about the idea of markets as a leading economics, and what that really means for investors. So what we have here is the S&P, how the S&P 500 has moved in and around previous recessions. First, in the upper left here, we have 2008. As you can see, during the recession, the S&P 500 topped and began to decline about 3 months before the recession began. And then it bottomed and began recovering about 3 months before the recession, from a data perspective, actually ended, right? This illustrates that idea of markets leading the economy, right? They don't trail, they lead the economy. You may think of this as a one-off, right? Maybe you don't think this is representative of what we have seen historically, but it's not, right? This is how markets work the vast majority of the time. So let's take a look at a couple other examples. In 1990, very similar effect, right? And in this case, markets actually bottomed and began recovering just a few months after that recession began. 1981, here on the bottom left, this was a rough recession. It was deep, it was long, but again, we see markets leading both the way up and the way down. And finally, we'll take a look at 1973, also a pretty tough recession. We see the exact same phenomena, right? Markets leading the way, both down and up, coming out of those, going into and coming out of those recessions. If we take an even closer look at these, right, you can see the recessions of 1981 and 1990 actually reach an all-time high before the recession actually ended. If this sounds familiar, right, and it should, it's because one of the biggest concerns on people's minds today, right now, is how the market can possibly be at all-time highs while we're still kind of in the midst of this recession and in the midst of the beginning of recovery here, right? The answer is really pretty simple, right? Markets are forward-looking, they're not backward-looking. If you go through and analyze all the previous US recessions, back to the Great Depression, you'll find very similar behavior in the vast majority of cases. Any exceptions that you do find really just prove the rule. So why is this important? Right, well, it's important because it makes investing incredibly difficult. There is always an element of the unknown. And as investors, we tend to be much more comfortable with reaction rather than prediction. So when market prices shift and change, and we see those shifts and shocks, we have a tendency to want to make changes which might not always be in our best interest. So let's take a look at human behavior at work and what it means for returns. So this chart here illustrates returns of different investment portfolios, different markets and asset classes over a 20-year period ending in December 2018. Right, so from 1999 to 2018. This information is put out annually by a company called Dalbar. And this company studies investor returns and behaviors and compares them to portfolio and market returns. As I mentioned, right, humans were very, very reactionary. We struggle to see that short-term returns are not serially correlated, meaning that what happened yesterday has little or no effect on what happens today, and even less on what's going to happen tomorrow. But this period from 99 to 2018, it was a really tough 20-year period. One of the most difficult we've seen in a very long time. But portfolios still did pretty well, right, despite these difficulties. S&P 500 in blue there on the far left, annualized about 5.6% total return. And then blended portfolios that included bonds, the 60-40 in the green and the 40-60 in the orange, weren't too far behind. Right? They did all right as well. And even the aggregate U.S. bond market, which typically doesn't get a ton of growth, averaged 4.5% annually. The really startling number here is how badly average investors performed over this same time period. They annualized just 1.9%, right? It doesn't even keep up with inflation. This isn't a one-off either. I've looked at dozens of these studies, and I always see the exact same things. Investors drastically underperform the assets that they're invested in. So let's take a look at why this period was so difficult and what caused that average investor return to be so low. This is a graph of the S&P 500 during that exact same time period, right? 1999 to 2018. As you can see, it was a rough 20-year period. 2 bear markets, multiple corrections. The reason that average investors did so poorly over this time frame is because when the volatility kicked up, right, and we saw those downturns, our emotions kicked up right along with that volatility. And we made changes that weren't always in our best interest. That 1.9% annualized return is a result of something like, buying all tech in 1999, selling stock when we were close to bottoms in 2001 or 2002, then buying stock back in the mid-2000s just to sell again in 2009, and then probably waiting to get back into the markets until we were close to all-time highs in 2011 or 12. Resulting in what we want to avoid, right? Buying high and selling low when we'd rather do the opposite. I think Benjamin Graham summarized the solution to this phenomenon very well, right? When he said, investing isn't about beating others at their game, right? It's about controlling yourself at your own game. And what this means is when you decide on an investment strategy or you have a portfolio that you put in place that you know is going to get you to where you want to go, you have to stay disciplined to it and not make those changes when the volatility kicks up and our emotion kicks up. So now that we've discussed how markets work and what makes them so difficult to navigate, let's dive into those current events I was talking about today. Let's start with everyone's favorite topic, politics, and the recent presidential election. I think if we were having this meeting in person, I'd ask everyone to leave their knives at the door and ensure any silverware that might be put out on the table is plastic. This is a tough topic, right? It dredges up a lot of emotion for all of us, and I'm going to try and keep it market focused and objective. I do think it's important to note that personally, I'm very politically agnostic, and in fact, I think if you asked anyone who knows me well, they would tell you that I have a fair amount of disdain for politics and politicians in general. I'm going to share a quote by a man named Ken Fisher, who you may have heard of. I think it summarizes my thoughts well, and it always gives me a good laugh. Right? He said, the word politics actually describes politicians themselves. Right? Poly meaning many, and ticks meaning blood-sucking creatures. So, of course, this is a generalization, right? It does not describe every politician, but if nothing else, I hope it brings a touch of levity to an otherwise kind of very intense and emotional subject. So grab a drink of water real quick. So in order to wrap our minds around what the results of this election may bring and how markets may react to who ultimately sits in the executive office on January 20th, we'll use history as our guide. So what we have here is what I call a political scorecard. It breaks down how the S&P 500 has fared under different political parties and different structures of government going back to 1926. It's hard to go back further than 26 because the data gets a bit fuzzy, and we want to make sure that the analysis is accurate and not clouded with bad data. Garbage in, garbage out, if you would. So from 1926 to 2019, there were 94 calendar years. Of those 94 calendar years, 73.4% of them had positive returns in the S&P 500. We had a Republican president sitting for 44 of those 94 years, and we saw a little over 70% positive returns. We had a Democratic president sitting for 50 of those 94 years with a positive return of about 76%. You do see a little bit more positive returns with a Democratic president, but given that we only have 94 data points, I would say that it's not really statistically significant. So to me, those are kind of within error. And so the difference between 70 and 76% is really not something that I would say is statistically significant, and we would see better returns with a Democratic president. I view those as very much the same. When we look at structure of government, we see a similar phenomenon, right? When a single party is in control of all three branches, we've seen that 51 of 94 years, and we saw about 70% positive returns. When we had a gridlock government, which means the two parties controlled part of the government, that was 43 of the 94 years, and about 76% of those as well were positive. So again, the same phenomenon here. It does look like we're leaning a little bit more towards gridlock being more productive as far as the mix of parties, but I would say it's probably not really statistically significant, and those are similar results. Analyzing all this historical data tells me that politics may not have as big of an effect on markets as we sometimes think they do. Right? We all have our beliefs and our ideologies, and when someone who is in office believes differently than we do, we have a tendency to think that it's going to be bad for markets and going to be bad for the economy. But that hasn't always really played out historically. Right? The reason that politics don't matter as much as we think they do is because markets and profitability are influenced by innovation and consumption. So as long as entrepreneurs keep innovating and people keep consuming, businesses will continue to be profitable, right? And markets will rise accordingly, no matter what the political backdrop looks like. This doesn't mean that there isn't market risk in politics and government. Let me say that one more time, right? This doesn't mean that there isn't market risk in politics and government. It just has less to do with the party that's in power, and it has a lot more to do with their ability to make sweeping changes that might affect things like property rights or the redistribution of wealth. Right? What I'm driving at here is the separation of power, political gridlock, and how those big decisions, those big changes are made. Put very simply, gridlock is good, and our government, for better or worse, is designed to accomplish very little, even when a single party controls, both Congress and the executive office. The reason it is hard to get major changes done in our government is because most big changes require a supermajority of votes, right? Which is a 2/3 majority in the Senate and in the House. If a party has a supermajority, then they can do things like override presidential vetoes, they can make constitutional amendments, and they can remove officials from office after impeachment proceedings, which cannot be done otherwise, right? And these are the kinds of sweeping changes that scare businesses and disincentivizes them from investing in the future. A supermajority in the Senate is 67 seats, and in the House is 290. But let's not forget that all-important filibuster, which we all love to watch so much. And it requires a 3/5 majority, or 60 votes in the Senate, to overcome, right? So you need 60 votes to overcome someone trying to filibuster a law going through. So the minority party can still stop the vast majority of legislation if they have over 40 seats in the Senate. Long story short is that supermajorities are incredibly rare, and they've only really happened twice in history, once during FDR and once during Lyndon Johnson's presidency. And without this supermajority, sweeping changes are incredibly difficult. And this means that businesses are going to have a clear view of the future, even when a single party is in control. It's really more about uncertainty than it is about the policies themselves, right? Even if a policy is not favorable to businesses, and they can still be negotiated and navigated, right? If it's clear, if that policy is clear and unlikely to change rapidly, right? Uncertainty equals risk for business more so than the policies themselves. I'm not going to delve into the presidential election results. There's too many unknowns, not to mention emotion that's tied up in those results. And speaking frankly, it's not really that important for markets over the next couple of years who ends up being in the executive office. Post-election, right? What we do know is that Democrats are going to continue to control the House. But there are still some unknowns with the Senate. And what we really want to know is if we're going to have a legislature with sweeping authority, right? So let's take a closer look at the composition of the Senate and see what we can glean. So coming into this election, Republicans had 53 seats to the Democrats 47, gave them a slight majority. But as you probably know, right, not every seat is up for re-election in every election year. They're split into 3 classes specifically for election purposes, right? They stagger them every 6 years, barring any special elections, of course. Stagger them every 2 years on 6-year terms. In 2020, all 33 Class 2 senators were up for re-election, and there were 2 special elections that took place in Arizona and Georgia, totaling 35 seats up for grabs. Of those 35, 12 were held by Democrats, 23 by Republicans. This structurally favored Democrats, right? Gaining some seats because they had less to lose. So what's happened thus far? Well, despite the media kind of going on and on the last few months about a blue wave, the Republicans had a very strong showing, and we know for sure they've retained at least 50 seats in the Senate for the next 2 years. But it's not quite over yet, right? All sights are set on Georgia, right? There are 2 remaining seats up for grabs, both in Georgia, right, that will determine what party actually gains the majority in the Senate. Unfortunately, we won't have the results for a while. These are set for a runoff that'll take place in January. But what we can do is do some analysis and see what we can take away from that analysis. So the first race is the regular election, right? It was the one that was scheduled for 2020. Pitting David Perdue against Jon Ossoff. David Perdue is a Republican and the current incumbent. This particular Senate seat has not voted in a Democrat since 1997. The special election is between Kelly Loeffler, I think is how you say her name, and Raphael Warnock. Kelly Loeffler is a Republican, also the incumbent, and this seat hasn't voted in a Democrat since 2000, right? So both of these seats tend to lean Republican in recent years. If we go a level deeper, right, we can see that the composition of Georgia's state legislature is about 60% Republican, give or take. And this tells me that the most likely outcome is that Republicans hold at least one of these seats, right? And the Democrats would need to win both in order to gain a majority, assuming that Biden's lead holds, as the Vice President Kamala Harris would be the tiebreaker for the Senate if that does take place. So if I'm right, and if this analysis plays out, then we're looking at a very gridlocked government, right? And this is good for markets, but can be very, 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 very frustrating personally, depending on which side of the aisle you may be on. So even if the Democrats can overcome the odds and pick up those last two seats, they're still a long ways away from a supermajority or even a filibuster-proof majority, right? There is still some uncertainty that's looming as this election is coming to a close, but we can be fairly certain that this election has not produced lawmakers with sweeping authority, right? That ability to make massive changes. Thus, businesses will have a clear picture of the future. They'll be able to navigate and invest, which is ultimately a tailwind for markets, at least over the next couple of years, until that next set of midterms, when we all know the circus goes back on the road. Well, in Georgia, the circus is starting back up until January, but we have a couple more years out here in the Pacific Northwest. All right, I'm going to switch topics now. We're going to talk a little bit about COVID-19 and its impact on global markets.
Ben, this is Todd. Could I just interject something? Just a reminder to please, if you have any questions as we go along through the presentation, please submit them to me as moderator in the chat section, so make sure that we can answer those questions following Ben's presentation.
Great. Thank you for the reminder, Todd. So before I go into the details here, I just want to acknowledge that this virus and the reaction to it has caused a lot of hardship for a lot of people, a lot of families. And although I'm focusing on market impact here, my thoughts and well wishes are with those that has felt that hardship, and I really do hope that all this will be over soon, and that those that have been impacted can regain some semblance of a normal life and kind of get back to having some happiness, perhaps. Unfortunately, this kind of dour sentiment plays into one of the major themes I'm going to be talking about on this subject, right? And that is what's called the K-shaped recovery. I'm sure at this point you've all heard the term, right? K-shaped recovery, but what is it actually referring to, right? What does it mean? Well, think about it as two very, very different groups of people with very different recovery paths. One that is older, very well educated, probably already wealthy or with very high earning power. They're either retired or working in a professional setting, maybe nearing retirement. And one that is much, much younger, right? Much less educated, likely works in the service industry or is consumer facing in some type of retail situation. These groups have had very, very different experiences during the pandemic and the subsequent lockdown. The first group, right, they felt some hardship, like their investments being volatile, having to transition to working from home versus working in the office. For some of the older folks, a lot more self-isolating, which has been very difficult and very frustrating. But in general, right, speaking in generalities, This group has kept their jobs, they've kept their earning power, their investments have recovered, and in many cases, the ones that are still working, they may actually be making even more money now than they were before, as they're replacing some of the workers that have been laid off and they're working overtime, things like that. Overall, this group has recovered very quickly, if they even had to recover at all from a monetary perspective. By stark contrast, group 2, they lost their jobs. They may or may not have been able to get unemployment. They're being replaced by forced technology adoption in the workforce. This group is going to struggle for a very long time to come. I'll share a quick story anecdotally. The other day, I went to a restaurant where I scanned a QR code that was on the table, and it brought up a website where I saw the menu, ordered my food, and paid my bill all from that website. There was one waitress in the establishment tending about 20 tables. The point of this story, right? It's to demonstrate how businesses have been forced to adapt, and that the people who are being hurt the most by this forced technology adoption are on the lower income bracket, right? Natural technology adoption is very, very different, because as businesses naturally adopt technology, the support jobs created for that technology naturally will replace the ones offset by that technology adoption. But when it's forced adoption, the replacement jobs haven't been created yet, right? And this results in a net increase in unemployment for that group of folks. So let's take a look at what that actually looks like from a statistical perspective. One of the ways to look at who is losing or keeping their job is to break it down by education level, right? It gives us an idea demographically. So what you see here is unemployment by education over the last year, going from last September to this September. Color represents time period, and the data is grouped by education level. The blue bars are last September. Orange bars represent peak unemployment, which was May of 2020, and gray is September of this year's data, right, end of last quarter. On the left, that group, that cluster is no high school diploma. As we move to the right, you see high school graduates, then some college or associate's degree, and on the far right, we have bachelor's degree or higher. As you can see, the unemployment rate for the less educated demographic is naturally higher than those who are more educated. Since the peak here, we've seen unemployment rates fall kind of back down a little bit, but not anywhere near the pre-pandemic levels, right? Especially for those that are in those less educated brackets, unfortunately. But looking at the unemployment numbers alone does not tell the whole story. We need to also understand the size of the labor force, along with how many people have lost hope and are no longer counted in these unemployment numbers. This graph here, excuse me, shows the size of the labor force broken down by those same levels of education. Color, in this case, represents the education level, and they're grouped by date, so different than the graph on the left there. For now, disregard that cluster of columns on the far right. We'll get to those shortly. So blue is no high school diploma. Orange is high school graduates. Gray is some college or associate's degree, and the yellow is bachelor's degree or higher. The group on the left is September of 2019. In the middle is May, again, peak unemployment. And on the right is September of this year, so and end of last quarter. As you can see, the workforce that has a bachelor's degree or higher is much larger in size than any of the others. So changes that take place in this group have a much larger overall impact on employment numbers. But this group is also much less volatile than some of the others. So if we now take a look at that cluster of columns on the far right, let me zoom in here. This shows the change in workforce size by education from last September to this September. The only group that grew over the last year is the one with bachelor's degree or higher, right? So that group of that workforce is larger than it was a year ago. All the other three shrank, right? So what that means for the workforces that shrank is that people have become discouraged, right? They're no longer looking for work, or potentially they aged out as well. When taken in combination, right, with the increase in unemployment for those lower levels of education, the numbers are actually far worse than standard unemployment numbers allude to. So let's take a look at the real number of jobs lost due to this pandemic and the subsequent lockdowns. For simplicity of comparison, I've grouped these into two groups. Bachelor's degree or higher is in the blue on the right, and less than a bachelor's degree, right, is in red and on the left. As you can see, the lower end of the education spectrum has lost almost 10 times the jobs as those that are higher educated. Keep in mind that this group, right, this group of those other three groups combined is only slightly larger than those with a bachelor's degree or higher, right? This is a devastating insight for those that are on the lower end of that socioeconomic ladder. What has happened here in the United States is going to take decades to be undone. And the less fortunate are the ones who are going to pay the heaviest toll. And it's very, very sad. But let's shift over now to a slightly less dour note and kind of shift into talking a little bit about markets. So you've probably noticed by now that I like to use history as a guide and relative comparison for any current events. That includes the current pandemic, right? So to quote Mark Twain, history doesn't repeat itself, but it often rhymes. And I find this to be very, very true as I analyze historical data. So let's take a look at past virus outbreaks and try and wrap our mind around what's going on now from a relative comparison standpoint. This table shows the last 7 major virus outbreaks, how many deaths occurred, the total population at the time, and the percentage of population that was killed by the virus. Looking at aggregate numbers alone, it just doesn't paint the full picture, right? In order to truly compare, we need relative numbers, which means looking at percentages per capita based on population, right? So as you can see, COVID-19 has easily surpassed the death tolls of SARS, of MERS, and swine flu. But there are 3 pandemics that have taken place in the past 100 years or so that COVID-19 is really not anywhere near as of yet. Right? These are the Hong Kong flu of 68, the Asian flu of 57, and of course the notorious Spanish flu of 1918. COVID has actually killed more in total numbers than the Hong Kong flu of 68, but it would have to kill about twice as many people to have the same relative mortality rate based on the size of the population. This chart here gives you a graphical representation of where COVID is compared to the 3 most deadly outbreaks in the last 100 years or so. The effects of COVID-19, right? They've been no doubt devastating. They've hurt many people around the world, but in comparison to previous outbreaks, we're still a long ways away from COVID being the most deadly, if you would. The Spanish flu killed almost 3% of the entire world's population. Right? That's roughly 200 times more people compared to the size of the population at the time. To get to the level of the Hong Kong flu of 68, deaths would need to roughly double. To hit the levels of the Asian flu of 57, we'd need to hit roughly 5 million total deaths, or a little less than 5 times what we're seeing today. Is this possible? Sure, right? It's anything's possible. We don't really know what the future holds, but based on what we see right now, it seems fairly unlikely, right, to get to that point of any of those other three. So now we've established a basis for relative comparison, right? Now we can move on to the market analysis and what to expect going forward. So this table here shows those same outbreaks as on the previous slide, but here we're looking at stock market returns as measured by the S&P 500. I've broken this down by returns during the year of the outbreak and returns the subsequent year, right? So the year following the outbreak. All but one of these outbreaks had positive returns the year of the actual outbreak. This includes COVID-19, right? The S&P 500 is up roughly 12% year to date. 1957 was a really tough year in the markets, ending about 14% down. But all of this, plus some, were made up for the following year, right? That subsequent year, the S&P ripped almost 40% in 1958. Oddly enough, we also only have one negative result for looking at the subsequent year, the year following an outbreak. 1969, markets fell about 11%. Returns for 1918 and 1919 were definitely positive as we look at the data, but it's so far back, I wouldn't want to take anything or use these as a true comparison because the data does get a little bit fuzzy. What we can say is that one of the most prolific decades in history immediately followed the worst outbreak, right, in the modern world has ever seen. And what I'm referring to is the Roaring 20s, right? It was a great decade of progress. Looking at 1 and 2 year returns is all well and good, but it's still a bit myopic in my opinion. I'd like to broaden that. So what I did here is put a chart together for 5-year returns. And I left the Spanish flu out of this one because again, the data is a little too fuzzy that far back. This is a total return number, not an annualized return for the 5-year period following the outbreak, following that the month of the initial outbreak. So as you can see here, every example is positive, right? And 4 out of 5 are very positive. The only exception being the Hong Kong flu of 68. But this is likely due to some of the economic difficulties of the 70s rather than the flu itself. I mean, you probably remember some of that stuff that was going on that ultimately resulted in some hyperinflation. You had price fixing, all kinds of stuff going on during the 70s. Overall, this flu's been very difficult, and it's taken a very steep human toll, right, between the lockdowns and the virus itself. But for equity investors, it should do very little damage, kind of looking at the longer term. All right, enough of all that negativity. Let's dive into some key takeaways and talk about some forward-looking thoughts. Overall, bull market characteristics prevail currently, right? We should see some growth in equity markets over the next 12 to 18 months. Most leading economic indicators have recovered, right? They're back on the rise, and earnings have surprised to the upside during both of the last 2 quarters, and it's looking good so far here in Q3. This doesn't mean that there's not going to be any volatility, right? Specifically around the presidential transition and any potential negative COVID information like lockdowns and whatnot. But fundamentals should prevail, over the longer term. I believe that the current environment is going to favor technology as well as materials companies. You have that forced technology adoption that I was talking about. So even though tech valuations are pretty high for the most part, they should see some significant revenue increases over the next year or so. Material sector is going to benefit from increasing commodities pricing that will result from some of the supply disruptions that we have. And then as the lockdowns open up a little bit, you'll see demand for commodities start to pick back up as construction and manufacturing begins to increase a little more as well. Most of the other sectors should benefit from the rising tide, right? As the rising tide tends to lift all ships, but I still see some significant headwinds for energy in particular. Oil and gas production has proliferated significantly, and oil's become much cheaper over the last 10 years or so, which means that the companies that are based on oil and energy production are going to have some headwinds as far as profitability goes. Excuse me. Low and middle class families are going to have a hard road ahead. Not just over the next 12 months, right? Likely over the next 10 years. This is by far the biggest travesty, in my opinion, of this pandemic and of the results of some of these lockdowns. Especially because I do believe strongly that much of it could have been avoided. So I do think we get some market growth, right, over the next year or so, but there are some risks that could derail that or at least mitigate some of that. First, right, I've alluded to it a couple times now, right, another massive lockdown would definitely send markets back down. Probably not to new lows, but for sure they would decline and probably drag on maybe a little bit longer than we saw last time, but shouldn't hit new lows and probably more of a short-term risk. Global nationalization, it's hard to say. And I do know that it is a bit of an oxymoron, but what I'm alluding to is the trend towards nationalization, nationalistic policies. Globalization has reduced prices for consumers around the world, right? It's boosted productivity. It's expanded the size of potential markets. It's lifted the standard of living of people around the globe, particularly in emerging markets, right? It's been a very, very positive effect for the vast majority of people. If we see governments around the world switch to a more nationalistic policy overnight, right, and start engaging in trade wars, it could easily derail the market and cause a much longer term damage than any lockdown could do. But that being said, these types of policies usually play out over years and years and years and years. If that happens, it's still a headwind, right? It's not a positive, but you won't see fast corrections or put us into a bear market quickly if that does happen. We are seeing a bit of a contested election right now, but in my opinion, it seems to be pretty superficial. If true widespread fraud is found, the superficiality will fade away, right? And we're going to see a lot more market volatility. This is, again, still more of a short-term risk, but depending on what is uncovered, right, it could spill over into the longer term. But ultimately, business will continue, right? People will keep buying stuff, and life will go on, even with further contested election here. Lastly, and probably the most prominent risk, right, is a Federal Reserve misstep, especially while we're still struggling to recover. It could, if they do have a misstep, it could dry up a lot of the liquidity that's out there and result in a more prolonged downturn. Basically, this means if they do monetary tightening too soon, like raising the Fed funds rate or not providing liquidity to the repo markets before we're all back up and running, back to full speed. So far, so good. Agree or disagree with their policies. They've provided liquidity, and that's what's important for lubricating the gears of the economy. All right, I'm going to talk a little bit about portfolio engineering and portfolio construction. I'm not going to spend too much time on these next couple slides. So if anyone does want to dive in further, this is probably something we should talk about offline, which I'm happy to do. You can just email me, and we can set up a time to chat further about it if you'd like. Ultimately, the goal here is to help folks build portfolios that work for them and get them where they want to go with as little stress as is humanly possible. I hear the term diversification constantly, but I'm not sure that most people really know what it means. Right? It's one of those keywords that are just kind of thrown out there. To most folks, I think it means the idea of owning different stuff, right? Like having stocks mixed in with some bonds. But if those stocks and bonds move in the same direction, then what is the point of owning the different stuff? And I'm going to show you a couple of recent portfolio analysis that I've done for people lately, and how they're potentially kind of missing the point of what diversification is supposed to do. So what we have here is a list of their holdings on the right-hand side. Right? And you have a couple of T. Rowe Price funds, you got a Vanguard fund, and you got a couple of target date retirement funds. So a good mix, a lot of different stuff, has a lot of different holdings within them. And then we have this correlation matrix here on the left-hand side. The long story short here is if it's dark blue, it means it's very highly correlated to the other positions, to the other assets in the portfolio. The closer it is to 1, the more it moves in lockstep with those other positions. So if all the assets here are moving in the same direction, then why do we own them again? Right? What is the point of this sort of diversification and owning these different things, all this stuff? Let's take a look at one more. In this person's case, they own a lot more stuff, right? But they've created the exact same situation, right? A lot more funds, but very highly correlated, right? You got some American funds, some Vanguard, some more T. Rowe Price, Invesco, all kinds of different funds that should do different things. But the reality is they don't. Right? They move very much in lockstep with one another. The one light blue you see there is mainly cash in that fund. In fact, when you own a lot of different funds, you actually can decrease the efficiency of a portfolio because many of those funds actually will own the same stocks, right? They'll have overlap, and they all have to have large cash positions to facilitate things like redemptions. This can cause a lot of increased transaction costs, cash drag, and ultimately end in worsening of performance. So if owning lots of stuff, right, isn't the answer to diversification, right? How should we diversify? What should a properly diversified portfolio look like? So this is a portfolio that I built for a client, and as you can see, the positions I use have much lower correlations. This is strategic diversification, right? It's incredibly important to building proper portfolios. Sorry, I'm not going to share the positions that I use. Those are for clients only. It's proprietary info, but I am happy to do an analysis again, free of charge to anyone who may be interested later on. Non-strategic diversification, as I mentioned, right, it's owning lots of stuff for the sake of owning stuff. When you have positions with high correlations, they tend to move together very closely and create a roller coaster effect that the owner of the portfolio must ride, right, in order to reap any rewards. It begs the question of why, again, would someone own all these positions if they're doing the same thing? By stark contrast, using strategic diversification means using complementary positions, meaning that when one of your positions zig, the other zags, and it helps create a much smoother ride that's much easier to stomach for the investor. You know, when we go to Disneyland, we want a ride that gets our adrenaline pumping, right? Not so much when it comes to investing. There is nothing wrong with boring when it comes to investing and building a portfolio that's meant to help you live a better, less stressful life. So when we're engineering a portfolio, there are a number of things we want to consider, right? First, we want to select the right asset allocation, right? What mix of stocks and bonds is not only right to get me to where I want to go, but how much stock volatility, you know, can I stomach on a day-to-day basis? You want to build a portfolio of investments that complement one another, right? When one zigs, the other zags, right? It's not just about owning stuff, owning different stuff, different funds. You want to make sure that you're using efficient investment vehicles, right? Not too much cash drag, not too much stock overlap between the two. You want to make sure it works like you expect it to work, and you want to make sure you know those costs, right? If it's a mutual fund that you're using, you want to make sure that you know the expense ratios, you know the 12B1 fees, you know how much idle cash is in there, you know what the portfolio turnover is. You want to make sure you know all that stuff so you can identify what kind of drag it's putting on the performance. And then no matter what strategy you choose, right, no matter what your asset allocation is, what investment vehicles you use, there's going to be volatility. Understand what that looks like, and then, you know, no matter what happens, right, you got to stay disciplined. Once you put that strategy in place, you got to make sure that you stay disciplined in order to reap those rewards. Lastly, you know, for those of you that may want to elicit some help in financial planning or investment management, I'm going to share a few tips. So the first thing is you want to make sure you understand the difference between a broker and an advisor, right? A broker is somebody who sells securities. They have a Series 7 license. They're not required to have a fiduciary responsibility. These guys work at places like Ed Jones, Merrill Lynch, UBS, things like that. Advisors, right? They hold a Series 65 license. They do have a fiduciary responsibility. They can't sell any securities. They don't make commissions. And then you have the ones that are what are called duly registered. These, I think, are a big problem in our industry because you never really know if that person who's a broker and an advisor, you never really know how they're acting, right? Are they acting as a broker? Are they acting as an advisor? It creates a lot of gray area, in my opinion. You know, there's nothing wrong with a broker. There's nothing wrong with an advisor, but never the twain shall meet, right? And so I mentioned that fiduciary responsibility, right? That means that a fiduciary has to do what's in your best interest, the client's best interest above their own, right? If you want someone with a fiduciary responsibility, it's got to be advisor. If not, then a broker is a good spot for you if you're looking for research and to buy securities from them. You also want to understand their portfolio management style, right? Are they passive? Are they active? Do they use models? Is it in-house? Is it out-of-house, right? And what are the costs associated with each of those types of portfolio management styles? And I did mention, you know, getting commissions versus being paid in other ways, but understanding how they are paid is going to give you some insight into whether or not their incentives are aligned with yours, right? If they're selling a product, if they make a commission, there may be a conflict there. If they have an asset under management fee or a flat fee, there could still potentially be a conflict, but it's probably less depending on what you're trying to accomplish. So just know the difference between the two, understand what you want personally, and then do some research on these folks. These last two bullet points are resources. Brokercheck.com, you can jump on and punch in any firm or anybody's name, and you'll be able to see pretty much everything about them. The ADV2, which is available on the SEC website, right, advisorinfo.sec.gov, will tell you everything you need to know about a firm, right? Tell you what kind of clients they work with, what their strategies are, how their client service is, right, so on and so forth. It's a big document, right? Mine's about 35 pages, but definitely worth it if you are looking to choose someone. So that concludes my presentation here. Now we'll jump over to some question and answer.
Okay, thank you, Ben. Yeah, we've got some questions in the chat section, and after we go through those, we'll go ahead and open the mics for people to ask any questions that they have verbally here. And so let me take a look here at the questions in the chat section. Okay. One of the questions was, could you define what you mean by materials in more, I think you talked about the materials sector in a bit more detail?
Sure, of course. You know, there's 11 sectors as defined by GICS classifications, essentially, which is what we deal with from an investment management perspective. And the materials sector is specifically companies that deal with commodities, right? Think about like agriculture, mining, petrochemical, things like that. That specifically make up those materials types of companies and ultimately the materials sector itself.
Okay, thank you. One of the questions was actually a little intro here. Besides death, you know, COVID, you know, obviously this is a nasty disease. It can cause significant disability and many heart and lung damage, immune disorders, even mental illness, in other words. So it's not necessarily over when it's over. Is there any data that's out yet that lists potential long-term disabilities from COVID, and maybe compare that to some of the other pandemics that we've had in the past?
Not that I'm aware of that is, I would say, accurate, right? There's a lot of misinformation out there. And unfortunately with stuff like that, I think we're gonna have to wait until we get some more accurate information and more studies done on that stuff.
Yeah, it is pretty early on. Are you willing to share your results for some of your diversified portfolios over since you've been managing them? That was one of the questions.
I'd rather not on this particular medium. You know, as an advisor, I have to have a lot of disclosures and whatnot that accompany my performance numbers. Anything that's broadcast to a mass of people, like this webinar right now, is considered advertising by the state of Washington and by SEC. So I have to be very careful with that stuff. If you would like,
they can follow up with you individually.
Yes, absolutely.
That's what I would encourage you. Ben Melissa's contact information. Encourage anyone that wants to talk to him about that to follow up with him on a one-on-one basis. Another question that came in was, can you talk a little bit more about the Federal Reserve? It seems they hold rates low to zero, you know, and that also, I mean, that's in my own editorial here. It just seems like it takes some. The Fed ends up with fewer quivers, you know, or arrows in their quiver. You know, when Janet Yellen, the previous Fed chair, was raising rates, well, there was some room for the Fed to ease again. Now they've done about all the easing they can do. So do you feel confident they still have enough tools left to deal with the pandemic and the impact on the slowing economy?
I do. I do. I think a lot of the tools that they've used in the past have been fairly ineffective. Quantitative easing in particular is one that I'm not a big fan of. That's essentially manipulation of the yield curve, right? But liquidity is the primary thing that helps keep moving markets and keeps businesses, right? Availability of loans, making sure that liquidity doesn't dry up. And a lot of that can be done through the repo markets and through keeping shorter term rates lower, which that's where we're at right now. So right now, so far so good, but you know, you don't really know what the future brings. But I do think they still have a number of tools that they can use.
Okay. Another question asked, you know, what potential other, you know, black swan events or risks could derail your forecast? I guess you listed several risks, though, that you were concerned about. Anything else you didn't mention that could come out of the blue? Or
you know, Japan is a country that's not talked about very often, but it is a very large part of global markets and global business. Up until recently, it was the second largest equity market in the world, you know, behind the United States. And they have some kind of internal structural problems that they've been having for a very long time. If they were to, you know, implode economically, it's unlikely, right? But if that was to happen, you'd have some pretty serious residual effects across the globe from that. But that's one that people don't talk about very often, but I think is something that should be on a lot of people's radar.
I know Ben Bernanke focused a lot on the risks of Japan and not wanting to repeat them.
Right.
We have a question specifically about about the registered investment advisory designation. And is that a specific designation? And are they the only ones that are technically considered fiduciaries?
Yeah, so a registered investment advisor is absolutely a designation, right? It's a Series 65 license or a combination of other licenses that gets you to a registered investment advisor. And yes, that is the one that has to act as a fiduciary. Are there other less known ones out there? I'm sure there are, especially when you get into some more private stuff. But from a industry perspective, right, the Series 65 licensed RIA or registered investment advisor is the one that acts as a fiduciary.
Okay, good. Another question came out about funds that are investing in cryptocurrencies. Do you have any opinion on the cryptocurrencies in that sector?
I do.
Okay.
I do have some opinions on cryptocurrency. It's a very, very speculative instrument, right? It's what's called a non-productive asset, right? Which means it doesn't accomplish things. It doesn't produce revenue or profits, right? It's very speculative by nature. And I believe very strongly that people who are investing in cryptocurrency or speculating on cryptocurrency, in most cases, are doing it with the wrong idea. They think that by a cryptocurrency becoming more accepted, right, and proliferating, that its value is going to go up. But in fact, the opposite is true. If it is to become a currency, right, that means that it needs to have a much more stable value. Right, it needs to be widely accepted, and it needs to have consistency in value, or people won't spend it. Right, if it's wildly up and down, people won't spend it. So, in order to have consistency, it's likely that the value needs to come down farther, and you have to have a lot more transactions. If that happens, you'll get stability, but the people who are investing in it thinking it's going to go up because of proliferation, it's the wrong thesis to own. If you're just speculating on it, right, then that's outside of my realm. You know, have at it. It's not something that I particularly do, especially for my clients, right? But it's tulip mania, right, of the 1600s, in my opinion.
So you don't see it as, you know, there's been, of course, concern about the dollar weakening with, you know, fiscal imbalances, et cetera, in the U.S. You don't see cryptocurrencies as being an alternative currency in a situation like that where the dollar might fall out of bed?
I think it could. I think there's a potential for it. I wouldn't say it's likely, but I think there's a potential for it. But if that happens, again, it has to revert to stability of value, right? And if it reverts to stability of value, the thesis to own it for appreciation, right, goes out the window.
Right. Yeah. The what you one question was addressing the growing concern about the rise in the national debt. I guess this ties into that and the effect on the overall economy. How about that, and how much of a wild card is that?
So, you cut out there just for 1 second, Todd. Could you
Oh,
repeat that
okay,
for me?
sorry. The growing concern about the rise in the national debt and how that could weigh on the economy and then the financial markets over time, especially in a time like this when in a period of uncertainty with this pandemic.
Got it. Got it. Yeah, good question. National debt is something that comes up, all the time. There's a few things that you think about when you talk about the national debt and right how it might affect markets. The first is the composition of the debt, right? How much is truly outstanding, right, and owned by foreign nations versus how much is kind of owned and internally in the United States by different agencies and kind of a little bit of a shell game, if you would. So the rough composition of the national debt is about a third of it is owned by U.S. citizens, people. About a third of it is owned by foreign governments, and about a third of it is owned by other governmental agencies, right? So what that means is they're just kind of swapping debt back and forth between the different agencies from the Federal Reserve and whatnot. So a third of it, yes, it is debt. Yes, it is an obligation, but it's built kind of within the system. So the number that we're seeing, that total number, is much higher than what the true obligation is, I would say. And the second part of that I think is very important is the cost of debt servicing, right? So how much does it cost our federal government to continue to have that debt? Think about like interest payments, right? How much does it cost? And it's actually cheaper now than it has been in a very long time, right? Because the interest rates are so low and we've swapped out so much of our higher interest debt for lower interest debt. So as of right now, our government's actually paying less servicing costs than it did 20 years ago, right? So it's actually cheaper for them now. It's less of an obligation for them now.
That's an aggregate?
Yeah.
In aggregate service cost, dollars. Okay,
Yep.
okay.
So as of right now, as of right this second, it is not, in my opinion, a immediate threat to the markets, to the economy. It is, however, a much longer term problem, right? At some point, right, you reach that tipping point. How long is that? Hard to say, probably at least a couple of decades out, right? We're significantly behind Japan, right, as far as debt to GDP goes. And Japan still seems to be doing okay, although there are a lot more concerns there. So is it a longer term problem? Yes, something that needs to be addressed, but in the short term, the next 10 years or so, I highly doubt that it will cause any major issues in the markets or economy.
This next question kind of ties into that with concerns about the national debt and the potential weakening dollar further. Do you favor international equities or bonds versus domestic securities, given those concerns, perhaps more than you would have in the past?
No, I'm fairly country neutral right now. I'm fairly country neutral. There is some concerns about a weakening dollar, but any of those concerns about the weakening dollar also apply to any other developed nation, right? A weakening euro, a weakening yen.
Right.
They face a lot of the same headwinds that the U.S. faces. So when everything's weakening, nothing weakens, right? So from that
All
perspective,
relative, yeah.
From a currency perspective, I'm not really favoring one country over the other right now.
Okay. What about, and we touched on low interest rates earlier with the Fed's action. How are you concerned about the impact of rising interest rates on bonds going forward with rates so low? And I assume that this question was probably referencing investment grade bonds, government and high quality corporates with their question.
Sure. So obviously the price of a bond, the value of a bond, is affected by what the current interest rates are and compared to what that bond was issued at. If a bond is issued at 5% and our current interest rates rise to 7%, the value of that bond fall. The face value of it will. So it's an inverse correlation there. It is it's a lot more of a problem for people who use bonds as income generation, right? Because they're going to own a lot of like bond ladders and things like that, and that interest rate will affect that income generation and their overall value. I use bonds more as strategic diversification to my equities, right? It's about correlations. So interest rates, although they do affect the way that I build portfolios, they're not going to have a huge problem. They're not going to have a huge effect on my portfolios because they're all meant to interact with one another, right? If interest rates rise, that probably means we have an increased expectation for inflation, which means that you're probably going to see stocks probably grow a little bit more when that happens, right? You're going to see commodities inflate in price a little bit. So all those things will work together to make a portfolio move smoothly. If you're using bonds, however, just for income generation, it's going to be difficult.
Well, that's right. And I know some advisors are saying questioning the traditional 60-40 allocation. You see retirement plan, 60% equities, 40% bonds, or the other way around. So are you favor, and you really spotlighted equities more than bonds, do you favor a higher equity allocation generally than has historically been the case in balanced portfolios?
I do things quite a bit differently, I think, than what your normal advisor might do, right? Mm-hmm. The standard 60-40, it's not something I buy into, really. I build portfolios that are specific to what a client needs and what they want, right? And sometimes that takes 100% equities. Sometimes that takes 10% equities, right? So it runs the gambit, right? So you build those portfolios that you want to act a certain way for a certain client, essentially. I'm not in favor of here's a 60-40 model, go run with it, right? I don't do that. I don't think that's right for most people.
Good point. I want a follow-up question on the RIA designation. If you ask a prospective advisor if they are registered on, does that mean they automatically have a Series 65? And would the letters RIA always be listed after their names like a CFP would, for instance, as another designation?
Good question. No, they don't use the designation RIA in like their names or most of the time even in their advertising. Series 65 is the standard license, kind of if you're only registered as an RIA, right, as a fiduciary. You have people that previously had Series 7 licenses, which is a broker designation, but have decided to transition to a RIA, and they carry a Series 7 and a Series 66, if I recall correctly. I just carry a 65, so that's the one I'm familiar with. But those combination of those other two will also allow them to be registered as an investment advisor. Finding out if a person is only registered as an advisor versus dually registered can be a bit daunting. You can look at BrokerCheck, that website that I put up there, www.brokercheck.com. And if you punch in the person's name, it'll have either an IA in a little circle on it or a B in a little circle on it. IA means investment advisor, B means broker. If they have both, that means they're dually registered, right? So like if you look at mine, for instance, it just has the one IA circle on there.
Gotcha. Okay. Thank you. Just a follow-up question on the cryptocurrencies. One questioner was saying, I might be concerned if a fund that I think is traditionally a diversified equity fund is investing in cryptocurrencies and not telling me. Is any of that going on, or do you think people are going to stick with cryptocurrencies specifically in vehicles that have that label?
So the way that funds, specifically mutual funds, right? This is more common in mutual funds, right? You don't see a lot of this in ETFs. Right. But mutual funds, they issue a prospectus. That prospectus guides their investments. They cannot deviate from that prospectus. So if you buy a fund that prospectus says we are a diversified equity fund, they are not owning cryptocurrency. If they change that, they have to tell you, right? They may tell you buried, somewhere within a million legal disclaimers in there, but they do have to tell you before they can just invest anything that's outside of their prospectus. So if you have questions about a particular fund, I suggest kind of digging through that prospectus, and you'll be able to tell exactly what's happening. I haven't come across any funds that have out of nowhere kind of added cryptocurrency to the mix. Usually they kind of stick to what they know and what they do.
Okay. I think we've got time for one final question here. We're a little bit after 10:30. Do you, well, one person asked if you would put your contact information up again on the screen when we're done here. And then someone asked about tax questions regarding RMD distributions. If you know strategies to reduce taxation on RMD distributions, and I guess that date has been extended for, as I recall, for when you have to take RMD distributions post-COVID.
Sure. So I'm not a CPA, right? Let's start with that disclaimer. Not a CPA. So your individual tax situation is not something I can necessarily speak to. That being said, the government, right, Uncle Sam, they want their taxes, and they're going to force you to take money out of your IRA or 401k or whatever tax deferred vehicle you have, right, when you turn 72 now, right? You're going to have to take that money out. You can't not take it out, which means you're going to have to pay taxes on it. The only way to reduce that obligation is reduce the amount you have to take out by doing Roth conversions before you turn 72, right? And Roth conversion means taking a tax deferred asset, moving it to a tax exempt shell, paying taxes on it then, and then letting it grow after that. And then you're not required to take a minimum distribution out of a Roth account like you are a traditional IRA account. But you still are having to pay taxes on that IRA, just sooner rather than later, and hopefully less rather than more.
Okay, thank you. So I think that's it for the questions. I think we've used up our available time with the questions in the chat section. Again, if you'd like to put your contact information up there, Ben, or share that with us one more time. A couple of people asked about that. And there we go.
Sure.
We can see that. Okay, well, Ben, again, really thank you for the excellent presentation and answering the Q&A so thoroughly. And also want to remind people that, again, our next meeting is going to be Saturday, January 9th. And information on that speaker going to be sent to you very soon. And we, of course, reminder of Andy Proffitt's income SIG group meetings that he's doing on Sunday afternoons, usually the first or second Sunday of the month. Get in touch with Andy directly if you want more information on those. Those sessions have been excellent, and he's had some great speakers himself. So remind you of that, and appreciate everybody's time today. We're out of time, and you know, if you have any other questions, you can send them in. We'll keep the session open. Maybe we can forward those to Ben afterwards. But thank you everyone for your time today, and we look forward to seeing you at future meetings.
Thank you, everybody, and thank you, Todd, and thank you to AAII for having me today. I very much appreciate it.
You bet, our pleasure.